Hi there. In this video, I will walk you through a very speculative Netflix put ratio trade built around earnings volatility and the negative gamma environment. My name is Gery and I'm the chief options expert at TanukiTrade. The idea behind the trade was to take advantage of the elevated implied volatility and the pricing skew ahead of earnings using a 2-to-3 put ratio structure designed for flatter breakeven and positive theta while positioning around key put support levels. After the earnings, implied volatility collapsed and the position opened up nicely, creating profit opportunities without major adjustments. However, as market conditions became more unstable, I decided to close the trade early and lock in gains rather than aiming for the maximum theoretical payoff. One of the key lessons here is how put ratio spreads benefit from volatility contraction and controlled price behavior, and why disciplined profit taking often matters more than holding for peak potential. So let's get to the recording. In this video, I want to show you a new position that I have just opened on my live trader account on Netflix. Here you can see the Netflix chart with the GEX profile, and as you can tell, we are below the HVL line, which is the high volatility level. So that's why we are in a negative GEX environment or negative GEX profile. We have an 85 as a current put support on the downside, and there's a high pricing skew on the call side, which means the calls are much more expensive than the puts. And this trade is pretty speculative because earnings will come around after the market is closing today. And that's why implied volatility has been rising in the last couple of weeks. And here's the position that I opened for this speculative play, which is a put ratio spread for the 20th of February. And as you can see, there is an 89 and an 86 legs in this put ratio. And I usually trade the 2-to-3 ratio in terms of put ratios. The classic put ratio is 1-to-2, but I like 2-to-3 better because it has more flat delta and has lower or flatter break-even on the downside. This is a pretty speculative position because if there is a negative reaction after the earnings is out, then Netflix price can gap down below the put support and can go further down. And right now what we can see on the risk graph is that my lower break even is below 80. And if we look at the chart, the 80 is another put wall right now. And this is also below these technical supports from the past history. So if we are gapping down below this line, the position will make a loss, or I will have to roll these legs further down. But since I am very comfortable owning Netflix around 80, I don't have a problem with this position because below 80, I will make a loss. But if I get assigned on the 86, I will make money on the 89. So that's why my break even is below 80 market level of Netflix. Here is the screenshot of the fill from my live trader account. Let's see what the earnings will bring. I will continue from here. It's the 21st of January, and as you can see on the daily chart, there was a huge gap down in terms of the price movement of Netflix yesterday after market, and we were around 82. This was the low of the day, and right now the market is trying to go back up. The 85 put support did not change at all since yesterday, but implied volatility has been falling, which is pretty normal. If you double click here, you can see the implied volatility move better than on the bottom part without it. But actually what you can also see that IVR, IVX and everything went down, also implied volatility and obviously the call pricing skew as well. So let's see how the position is doing in this market condition. Here's the put ratio spread. And what I wanted to show you is that since implied volatility has been falling like crazy, this made it possible to open up the position a little bit because, as you can tell, there is a $62 unrealized profit in the position at the current market price, which is $84.55. And the other thing I wanted to show you is that if somebody wants to adjust the position, for example, to move the break even lower, someone could do like roll this up a little bit and then try to buy this back and roll it down. So for example, if I want to roll up the 90 or roll down, sorry, the 89 to 88, I could get 72 credit for that spread. This is this part of the spread. And I could buy back the 86 and short the 85, and that would cost me 55. I get a credit of 67 on this part and 55 spending here. So if I wanted to do this, then I could roll down the whole thing, and the break even will move a little bit lower, and the 85 would, or 86, the original 86 would move to 85. So that's just one possible adjustment for a ratio like that. I'm not going to move the position or adjust anything. It's kind of okay for me, because I guess the market will eventually fill the gap, and I still have positive delta, negative vega, which is good for the position because I expect implied volatility to fall further down, and also positive theta that will open up the position. If it starts to fall further, I might do this adjustment. We will see later on. There are still a lot of days in the position, because the expiration is on the 21st of February, which is from today exactly 1 month away. So there is no hurry in the position. I will continue from here. 23rd of January, we are on a Friday, and as you can see on the chart, we are above HVL line, and also the put support came lower, so that kind of a little bit bearish, and the IVR has been decreasing, and I marked when I opened the position just for easier following or tracking the position. So right now I opened the position here. There was a gap down on earnings, a little undecided candle, and then here the market is trying to curling up from the downside and trying to fill this gap. And I did not adjust anything with the position. I just wanted to show you a couple of adjustments for educational purposes. Here is the original position, and I did not touch it. Right now what you can see is that it's around $130 in unrealized profit. And what someone could do is, for example, roll down this strike, this 89 to 88, and then you could get like $67 as a credit. This is just one possible adjustment if somebody wants to have higher positive delta. And the other one is, for example, if somebody wants to also roll down the 86 to 85, because 86 is the short, you can do it by buying this debit spread. So if you do both together, then you would create a lower break even. And the other one that might be a possible adjustment here, if somebody wants to do it, is, for example, selling one complete vertical spread from this 2/3 ratio spread, which would create, I'll show you, which would create something like this. That's why the 2/3 ratio will become 1/2 ratio, because you sell 1/1 from these strikes. And then if somebody is concerned about the downside, that's also possible to eliminate after a couple of days and being in a profitable state by buying an 81 put on the downside, and then this eliminates the naked position or naked part of the position. Or you could just roll it up to 82, and right now it's like zero possible downside risk, and there is only upside potential. And if the market stays here, it can make money with positive theta, but obviously theta will become a little bit more flat, and also the delta with these adjustments. So actually these are possible adjustments that I could do at this stage, but I'm not going to, because I think that the market will at least fill the gap, and I want to harvest theta during the weekend, and also want to be in a more positive delta state. So that's why I stay in the position without any adjustment. So let's continue from here. It's the 26th of January, and as you can see on the daily chart, Netflix just filled the gap from the previous gap down, this area. And we are still above HVR, so it's kind of okay, but I have to watch the HVR level. If it's broken, that the market can again be in a more volatile period, so that's what I need to watch. But the other thing that might confirm the bullish thesis is that implied volatility is still falling and we have still a call pricing skew. But anyway, I have to watch what happens after the gap is already filled. And I wanted to show you the position and what someone could do in a situation like this. So as you can tell, we gathered some more profit since my last recording, around 150. And there is another adjustment that someone can do. For example, like buying this back ratio, the 89-86, remember this is at 2-3, and buying the 1-2 means that I am spending 81 bucks as a debit on it, and I close down this part of the spread. And what if I could create a condor that is riskless? So for example, if I put on this trade and open a new one on the downside, the 82.79, that would create this kind of very nice condor that would have no risk in it. Because if you look at it, the worst thing I can make is $26 on the downside and the same thing on the upside. It can be a broken wing, it can be a wide one, it depends really on the trader. It can be something that makes a loss on the downside. The one thing I would look for is the data, like what data I eventually want to have in the position in a situation like that. What I would look for is definitely the data and what kind of data I want to have in the position, and also what is the risk of the position. So if I, for example, did that as an adjustment, there would be absolutely no loss in the position or no potential loss, and still could make around 300 maximum if Netflix happens to expire around this area. But since there is a lot until expiration, because this is the 20th of February, I am not assuming that Netflix will close or expire between these levels. So I'm not going to do this adjustment, although it looks very nice, but I would like to keep this open and watch the HVL. If it's broken, then I might do something else or roll down or different scenarios I need to think about then when the market is breaking maybe on the downside for HVL. But right now it's a very nice position, still positive data. Positive data become neutral and negative by time in the working effect of charm. So this will create a negative data position in the next couple of, I'm not saying days, but probably next week. So right now theta is positive, making money. So if the market is moving within this range, then I can still harvest theta and stay in the position. So I just wanted to give you a short update on it, and I will continue from here. It's Thursday, and as we can see on the daily chart of Netflix is that the classic pattern happened again, that there was a gap fill on the upside and then the market turned down. We have an 80 put support on the downside, but I don't like how the market is progressing because SPX is down 1%, VIX is up around 15%, all the tech stocks are down, so I decided to close this position because I might look for another put ratio with better risk reward than this one. So here is the position. As you can tell, it's around $87 in unrealized profit, but I closed it earlier for $55 as a credit. So as you can see, the profit that was realized is 105, so $105 on this one, which is around 20% of the maximum gain, maximum potential gain, because around this area is the maximum potential gain. I never calculate with the peak. So it was around $500 and I closed with 100. So it's around 20% of the maximum profit. It's not bad, but it's not the best either. Here's the screenshot of the fill. As you can tell, I sent the order for 50 credit, but it was filled for 55 credit. So that's why it's a 105 profit, because initially I also got a 50 credit for this put ratio. And I could close down for 55. That's why it sums up for 105 credit. So the position is closed now, and I hope you gained some insights from these adjustments and ideas. Let me know if you have any questions. Thank you for your attention. Take care. Bye. Thanks for watching. If you haven't yet, please subscribe and check out our other videos. You can always find us at the links in the description. Trade safe out there.